student, take you through the content of the presentation. I would like to have a quick recap of what we did in our last class. So, study thoroughly the journal entries in particular. So, characteristics of journal, limitations of journal, then steps in journalizing, simple and compound journal entries, discount and rebate. We have already studied this in our last class. Difference between trade discount, rebate, and cash discount. So these all points we discussed thoroughly. So today I'm going to take up the last two aspects which are very crucial and important before we conclude this chapter for all of you to understand. So let us see what are these two. So these are accounting entries of some specific transaction. I'll help you understand this. And secondly, the opening journal. So let's begin with today's discussion. The entries of some specific transactions. So what are these specific transactions when we talk about? So bad debts. Now let me explain you what are bad debts. Now debtors are the people from whom we have to receive money, usually for goods sold on credit. Goods sold on credit. All right. So they have to pay us. When we are making sales, the entry that we pass is debtor debit to sales, right? So this is the entry that we have already seen this. So debtors are debited and sales is credited. This is the journal entry we pass. Now when we receive money from them, the entry that we pass is cash account debit to debtors. All right. Now if the debtors they do not happen to make the payment after a certain period of time, these debtors are called bad debts. Debtors who are not paying us money after certain time period and we think that it is not going to be recovered from them, so we treat it as bad debt. Now bad debts are nothing but treated as expense or loss for the organization or the firm. I hope it is clear. Now what are the situations which are likely to happen when there is a bad debt? So when total bad debt is not recoverable, so there is bad debt, the entry that we have passed, which we have seen here, bad debt debit to debtor. This is the entry that we are passing for bad debt. All right, bad debt debit to debtor. So instead of cash, since we are not receiving cash, we are debiting bad debt and we are crediting debtor's account. Is this clear? Now when the total bad debt is not recoverable, so it is very clearly mentioned here that the total bad debt is not recoverable. So rupees 5,000 due from Ramesh are irrecoverable. Now we are sure that this amount is not going to be recovered. So what is the entry that we are supposed to pass if this be the scenario? When the total bad debt is not recovered means 5,000 rupees due from Ramesh are irrecoverable. So bad debt, we are passing this entry bad debt debit to Ramesh. Now it is very clear that the amount of rupees 5,000 rupees which was supposed to be received from Ramesh is now bad. So being amount due from Ramesh is bad. All right. So this is entered in the books of account. Now if the situation is the second, I hope this is clear. So bad debt, when we are considering it as bad, instead of cash we are writing as bad debt to debtors. So debtor is, by crediting debtors we are closing the account and treating it as bad debt. We have opened up one account by the name bad debt which is to be treated as expense or loss. Now when the total amount is from Ramesh which is not recoverable now, so we have treated it as bad debt debit to Ramesh. So this is clear. Now bad debt recovered, supposingly after having treated it as bad, then we have recovered something from him. So a part of the bad debt which has been treated as bad earlier is now recovered. So what is the entry that we are going to pass? Ram, a debtor who has been declared insolvent, received from his official receiver rupees 60 paisa in the rupee on a debt of rupees 10,000. So there was 10,000 rupees which was to be received from Ram, who was declared insolvent, but his official receiver has given us this confirmation that 60% of the amount which is due by him to us is going to be received. So when we have treated it, what is the entry that we have passed? So we have treated him as bad, right? So bad debt debit to Ramesh. Now we are recovering 6,000 rupees from him. So entry cash account debit or bank debit to bad debt recovered account. Ram account is now not existing in our book. Why? Because we have already cancelled it. Considering it, the due from him is bad. Now the new entry which is to be passed when earlier treated as bad is now recovered. So we have recovered bank account debit to bad debt. If we would not have treated it as bad, still waiting for it, and later on we came to know that only 60% is to be received. So is going to be received or received from him. So bank account or cash account debit, now there is a bad debt. We have not treated it as bad. So bad debt debit and to Ram. So how much bank 60%? 60,000 6,000 rupees is received, 4,000 is bad, and total is 10,000. All right. Now situation 2, let us see. When written off bad last year, now recovered. So we treat this, we have already treated the amount as bad last year, and now the amount is received. So the entry we have already seen. What is the entry that we are going to pass? So cash account or bank account debit to bad debt recovered account. Is this clear? So this is 1,000 rupees which was treated as bad has been now received and treated as being bad debt recovered. I hope this is clear. Now banking transactions. So let us see few banking transactions. Business normally makes transactions through bank, and what kind of transactions which happens? Let us say there are bank payments done, or there may be receipts as per the direction of the account holder. So receipts, there may be charges which are charged by the bank, then there may be interest charged or allowed or given. So situations, bank does enormous transactions on behalf of the customer or with the customer or account holder. So lot many entries are made by the bank for the transactions in terms of various activities, normal activity of a business or a bank which is done. Accordingly, the entries are made. So these are likelihood of the nature of transactions which are done by the bank. Now let us see goods given as charity or donation. The other one. So whenever there is entry in case of banking, what is the journal entry that we pass? Supposingly bank charges something. So we can say right here charges, maybe bank charges. Now goods given as charity or donation. So supposingly if goods are given when we are purchasing goods, what entry we pass? Purchase debit to cash if cash payment is made, right? So this is the entry. That means for the inflow of goods in the form, we debit purchase and cash is going out, so we credit it. Goods are given as a charity. So what we need to write here? So goods as charity or donation, goods given debit to purchases. We need to just do a reverse of this. If we do purchases credited, so to the extent of the donation given, we are reducing our purchases, or donation given to purchases. I hope this is clear. Goods given as sample. So this is also promotional. So sample debit, sample goods debit to purchases. So this is the entry that we pass for. All right. Now loss of stock by theft or fire. So usually our, in business term, we see that everything gets insured. So if there is an insurance taken for stock or goods, okay, general insurance we call it, the goods which are insured, in that scenario, whenever there is loss because of fire, the insurance company bears the cost. Loss, in that case, what is the entry that we need to pass? So loss due to fire, loss of goods due to fire, debit to purchases. Okay? So this is the entry that we are passing for the, if the goods are not insured, in that case there will be loss due to fire gets debited, and purchases to the extent gets credited because there is 1,000 rupees of loss. All right. Now, if goods were insured and insurance claim for the amount loss is lost. So if due to fire goods worth rupees 1,000 was lost, and let us consider that it was insured. So what is the entry that we are going to pass? So insurance company debit to purchases. I hope it is clear. So this is insurance company we are debiting because we have to receive receive this money and debit, let us say whole amount is received. So 1000 rupees we are going to debit insurance company and they have agreed to pay us this much amount. The insurance company debit to purchases and this is for making due insurance company. So we are debiting insurance company or due from insurance company is made. Insurance company done. Now, when insurance company makes us payment, maybe by check or cash, so we'll pass an entry called bank account debit, bank debit to insurance. I hope it is clear. Case if full amount is paid by the insurance company. So what is the entry that we are going to pass at the incurrence of the event? So insurance company debit to purchases. This is the original first entry that we are passing. When the insurance company paid the full amount, so entry we are passing is bank debit to insurance company. I hope this is clear. Being fully covered, fully paid by insurance company. I hope it is clear. Now, if part payment, which is 70% is paid by the insurance company. So for making it due, we will do this insurance company to purchases first of all. And when they are making the payment, entry we will do is bank debit. So 70% we have received. So out of 1000, let us say 700 rupees received. Out of this 1000 rupees of total loss, 700 to making due insurance company was debited with 1000, right? So we made a due of 1000 rupees, but we have received 700 only. So the loss, the remaining 300 is loss by fire debit to insurance company. How much? 300. If we combine these two entries, how it is going to appear? So bank debit, loss by fire debit to insurance company, which is going to be 700, 300, 1000. I hope this is clear. Drawing in cash. So we drew cash for personal use rupees 2500. Drawing is nothing but it reduces capital. So what is the entry that we are going to do? So drawing debit to capital being due for personal use. All right. So this is 2500. Now let us see the next one. Drawing of goods, took goods as per personal use, rupees 1500. So what is the entry that we are going to pass? This is not for, not cash is not withdrawn. Rather goods are taken for personal use. So we will do the same, which is drawing debit to purchases. And this will be deducted in trading account. So how much? 1500. So drawing of goods done. Is this clear? Purchase of sale of fixed assets. Entry if cash or deficit if credit. So if it happens, purchase of sale of fixed assets. So there may be situation that we are selling some fixed assets. So entry which is supposed to be passed cash or bank debit to fixed assets. I hope it is clear. So there will be, let's say if it is 10,000 rupees of fixed assets, 10,000, 10,000. This is the entry we are passing. Entry if cash, or if it is credit, in that case debtor or the person to whom, name of the person to whom sales are made, name to whom sales is done. Let's say Ramesh. So Ramesh debit to fixed asset. How much? Let's say 10,000. I hope this is clear. Now let's go ahead and see the next one. Expenditure on installation of machinery and on construction of building. So in both the scenario, what we understand here, machinery has a cost. There is a cost price and there is installation price. So a cost of machine is both, which is cost of machine happens to be both installation inclusive. So let us say if it is machine cost is 1 lakh rupees and there is an installation cost of 10,000 rupees. So put together is 1 lakh 10,000. 1 lakh 1,000. Is this clear? So expenditure on installation of machinery and on construction of building, both are, it is added and this is the value. Now comes the next one. Expenditure on incurred to make the assets ready for use is capital expenditure. So this is to be understood. Any expenditure which is made, incurred in order to make the asset usable is called capital expenditure. Freight, wages, installation of machinery, etc. These are to be taken into account. So entry which we are supposed to pass is, what is the entry that we are going to pass? Let's say machinery account debit to cash. If machinery includes freight, if machinery cost is cost price, buying price of the machine is let's say 10,000 and there was 1,000 rupees of freight and installation. So we will write here 10,000, 100, oh no, 11,000. Let's make it 11,000 and then cash cash also 11,000. This clear? Sundry expenses. So any expense which is sundry in nature, maybe a very small expenditure. So entry we pass is that expense, name of the expense, debit to cash or bank. Okay. So this is the sundry expenses made. I hope this is clear. Now adjustment entries. What are these adjustment entries? So we will see these are the adjustment entries are made at the end of every year. All right. So when we are doing adjustment entries, these are done at the end of every year. So it is something very important to understand that after having prepared trading account, profit and loss account, or in the course of preparation of trading account, profit and loss account and balance sheet, after having prepared trial balance, then we came to know certain adjustments which were missed during the day, during the year. So what are they? The important adjustment: closing stock or inventory. So how it is to be done? Closing stock or inventory valued at cost price or market price, whichever is low. So one understanding which you should be having is that closing stocks or inventories are valued at either cost price or market price, which then prepaid or unexpired expenses of insurance premium. So what is prepaid or unexpired expenses? So expenses which are paid in advance. So expenses paid in advance. Okay. So these are assets. For example, usually insurance premium which is paid for 1 year. So let us say 1st April to 31st March 2025 and 6. Premium paid is, let's say, 12,000. Okay. Now we are closing the book, or this is for the period, let's say 1st April to 31st, or in fact we can make it 1st January to 1st January to December, 31st December. So 1st January 25 to 31st December 25, 12 months, but our accounting period begins from 1st April 25 to 31st March 26. That, and if we are, when we are closing the book, what we have seen is that the insurance premium 1st April is paid on 1st April of the current year, paid till 31st of December. So but the premium is for the current period, which is 1st April to 31st March 26. If it happens to be the financial year, then January 2026 to 31st March 2026, which is 3 months. So for the current financial year, 3 months of premium is paid and 9 months period which is falling in the next year. So there is 3 months of prepaid premium. Premium which is used in the current year is for 3 months, and 9 months of advance premium which is paid. So when we are making this payment, which is advance for the next period, while we are preparing profit and loss account, our premium should be how much? Only for 3 months. So in profit and loss account, the premium should only be for 3 months and not 9, not 12 months. Why? Because we have used it only for 3 months. For current year, only 3 months premium is charged, to be charged. Outstanding expenses. So what are the expenses which are outstanding yet to be paid? Let's say salary outstanding, rent outstanding. So rent outstanding is a liability, salary outstanding is a liability. So entry which we are going to pass is salary debit to salary outstanding. It is yet to be paid. All right. So then next one, accrued income, earned but not yet received. So when we are not received yet in the adjustment, some entry which is shown as an income, let us say pre-received. Okay. So it is earned but not received, accrued income. So if we have income which is earned but not yet received, or commission which is earned but not yet received, so what is that we are going to pass the entry? Okay, so we have accrued income, and there is a parallel one which is and earned but not received is an asset. So it is receivable. So we will clarify earned but not received. So what is the entry that we are going to pass? Commission earned but not received. Maybe a situation we have earned commission but not yet received. So commission receivable debit to commission, right? So this is earned but not yet received. Receivable, and this is an income, so commission is credited. Income received in advance or liability. So entry we are going to pass. Let's say if we have received in advance, so pre-receive is a liability. Okay? So this is a liability. So income, that specific income debit to income in advance. Okay? So this is the entry we need to pass. Income is debited because we have our income is showing excess. So we need to debit it in order to reduce it to that extent. And income in advance is a liability. So we need to credit it. I hope this is clear. Now let's go with the next one. Depreciation. So depreciation debit to furniture. If there is a depreciation charged on furniture. I hope it is clear. Depreciation account debit to, let's say the amount up here. Interest on capital for the firm. The interest on capital is an expense. So entry which we are going to do, interest on capital debit to capital. So interest on capital is to be credited to capital. Interest on drawing similarly. So capital, it is an income for the firm. So what is that entry we are going to do? Interest on drawing is credited and capital instead of doing capital. So there is a, okay, so this is the interest on drawing. It is an income for the, so capital debit to interest on drawing. Okay. Opening journal entries. Now how it is we are going to pass entry opening journal, and we'll see all nominal traditional income and expense account modern classification are transferred to trading or profit and loss account. All assets liabilities modern or real personal are transferred to balance. So that means how it is to be taken up, assets debit to capital and to liability. So we have the formula asset is equal to liability plus capital or capital plus liability. So let us see that this is nothing but this is transferred to trading and profit and loss account. So opening entries, how we are going to do, so cash in hand. So very simple, cash in hand 6,000, debit, bank 25,600, goods stock 9,000, machine 45,000, furniture 18,000, furniture debtor. So there is debtor. We'll write here debtor 20,500, and again Neeraj 26,000. Loan is liability. Creditor, okay, and then the difference is the capital. So if we sum up all this and sum up these two which are given, so we can find the capital. All right. So this is the opening journal entry and how it is appearing in the assets. So we will prepare this balance sheet in this way. There is balance sheet, asset, amount, liability, asset. Okay. This is how our balance sheet appears. So here we put up all the assets like all this cash in hand, cash at bank, cash in hand, bank, and others. All here we are entering it, and here capital. We'll write here first capital, and then if there is additional capital during the current year, additional capital is also entered here. Finally, our balance sheet should tally. This maybe sometime balancing figure or here also closing stock. There may be balancing figure. This is how it appears. So assets and liabilities in the balance. I hope this is understood by all of you. So we have seen few transactions and their entries in the books of account. And how is your take on, and share with me your comments. The way I tried to cover a student, so I'll make you. So thank you so very much for being in here. It was wonderful talking. I believe the content we have covered today, or in fact, we did three consecutive sessions in which I have covered the journal entry from variety of perspective, which may be of a great help for you to understand the chapter, or not only from conceptual perspective but as well from education perspective. So I would expect you to, in case if you have liked the content, subscribe it so that it reaches to the larger mass and you also happen to get benefited out of it. Then share and your feedback in the comment section. If you have anything, any feedback, that would be a great sense of happiness. Accordingly, I can react and revert to you. I would also expect you to make a comment. Contact for any query. My number is given. Email ID is given. So I would expect you either WhatsApp me or can mail me or send a set of questions in the WhatsApp. Thank you so much for being in. It was beautiful talk. Very good afternoon. Take you through the content of the presentation. I will have a quick recap of what we did in our last class thoroughly. The journal entries in particular. So characteristics of journal, limitations of then steps in journalizing, simple and compound journal entries, discount and rebate. We have already studied this in our last class. Difference between trade discount, rebate, and cash discount. These all points discussed thoroughly. Today I'm going up the last aspects which are very, very crucial and important before we put this chapter for you to understand. So let us, what are these two? These are account entry, some specific. I'll help you and this. And secondly, the journal. So let's with today's discussion. The entries of some specific transactions. So what are these specific transactions when we talk about? So bad debts. Now let me explain you our bad debts. Now debt are the people, the debtors are the from whom we receive manually for goods sold or credit. So they pay us when we are sale. Entry pass debtor to sales. So this is the end we have already seen. The debtors are debited and this is credited. This is the journal entry we pass. Now when we receive from them, the entry that we pass is cash account debit to debtors. All right. Now, if the debtors they do not happen to make the payment after a certain period of time, these debtors are called bad debts. Debtors who are not paying us money after certain time period and we think that it is not to be recovered from them. We treat as debt. Bad debts are but as against loss of organization or firm. Is clear? Now, what are situations which are to happen? There is a so when bad debt is not variables. Bad debt tree that we asked, which we have seen here. I mean, bad to this is the that we sing for debt or bad debt to debtor. So in cash, not risk cash, we are getting bad debt and we are crediting debtor's account. Is this clear? Now, when the total bad debt is not recoverable, so it is very clearly mentioned here that the total bad debt is not recoverable. So rupees 5,000 due from Ramesh irrecoverable. Now we are not going to, we are sure that this amount is not going to be recovered. So what is the entry that we are supposed to pass if this be the scenario? When the total bad debt is not recovered means 5,000 rupees due from Ramesh are irrecoverable. So bad debt, we are passing this entry bad debt debit to Ramesh. Now it is very clear that the amount of rupees 5,000 rupees which was supposed to be received from Ramesh is now bad. So being amount due from Ramesh is bad. Alright, so this is entered in the books of account. Now if the situation is